anytime that you look at the historical seasonality of Bitcoin, the end of August into September, not a good time for Bitcoin. September is actually the only month of the year that historically is negative. All of the other months, sometimes they're big months up, sometimes they're small months up, but September is the only month that historically is down. So it's somewhat to be expected. The seasonality is here.
Pomp begins by drawing attention to Bitcoin's historical seasonality, a pattern many traders overlook. September, he notes, is statistically the worst performing month for Bitcoin. Unlike other months, which tend to be positive or neutral, September consistently trends negative. The weakness even begins in late August, which is no coincidence.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think that there are two different aspects that are at play here. The first is anytime that you look at the historical seasonality of Bitcoin, the end of August into September, not a good time for Bitcoin. September is actually the only month of the year that historically is negative. All of the other months, sometimes they're big months up, sometimes they're small months up, but September is the only month that historically is down. So it's somewhat to be expected. The seasonality is here. Now, also, why does it start in August and go into September? Well, what happens in August? The running joke. Everyone is on vacation. They're all somewhere else. They're not in front of their screens. You see this in the stock market, you see this in Bitcoin, etc. So I think that's one piece of it, is definitely that. The second thing is that as you look at the legacy or the traditional finance world, there's a lot of uncertainty still. There's a lot of speculation that's going on. Some people are trying to figure out what's going to happen with interest rates. Now we got a little bit more clarity, given that Jerome Powell has come out and said that he's going to likely cut rates in September. But I still think that there's a lot of folks who are saying, what are we going to do with our tactical allocation? If we have uncertainty, maybe we're not going to put as much money into the market as we previously thought we were. So what's interesting is Bitcoin is going down at the same time. The S&P has been going down over the last week or so, right? This is a thing that is a broad market pull down or a kind of resetting. Now, the reason why I think that's important, maybe the biggest takeaway from this, is what you don't want to have is you don't want to have Bitcoin's price go from $69,000 in November. It was $69,000, I think, on November 1st of last year, all the way up to, let's say, $150,000, which I pretty much have been saying I could see that happening in this bull market. If you just get a straight line there, then what ends up happening is you're probably going to get a very big dump on the other side, right? The bear market's going to be pretty brutal. So instead, what you want is you basically want these advancements in price. You want some sort of correction and resetting, right? You want to wipe out some of the open interest and some of the leverage in the system, kind of reset at a lower price, and then move up after that. So I think that's what's happening right now. I don't know where we'll kind of end up. Is 110,000, the bottom, 108, 105, 112, like somewhere in this general range. I think that we are going to reset, and then that gives us the ability to move back up. And so you can almost think of like setting a foundation of the price. All of the conditions become much more attractive and we go up. What I don't think people should expect is some like magical fast recovery. Remember, September on a seasonality basis is usually down. So I'm not saying it's going to be down this year, but I am saying that you should have tempered expectations going into this. And then the other piece is there's a lot of buying coming. Like, you ever heard of, people being like, what was it? The British are coming. Remember Paul Revere, right? He was running from house to house on his horse saying, the British are coming, the British are coming. The Bitcoin treasuries are coming. The Bitcoin treasuries are coming. Tell your friends. All of them are about to get access to their capital, and they're going to start buying in the market. And so it's billions of dollars collectively that should be buying Bitcoin. Now, there is not as simple of an analysis because some of those dollars are hedged. So when they put on the Bitcoin exposure, their investors are then putting on a short Bitcoin spot exposure. And so they can be kind of negated dollars. But I do think that as that capital starts to flow into the market, you're going to see a lot of people get very excited because there's going to be continuous announcements of people buying Bitcoin, right? Which kind of gets people excited. It's hitting the news. It's driving some FOMO to it. But the second thing is that if there's more buyers than sellers, the price should start going back up again. And so I think that this range that we're kind of in, call it 125 to maybe 110, we'll kind of hang out here for a while. But as we see these buyers come into the market, as we see the interest rate cut in September, like all of these components are going to feed into Bitcoin. I do not believe has topped in any way for this market cycle.
Then comes one of the most important macro insights. Bitcoin is the most sensitive asset in the world to global M2 money supply expansion or contraction. This isn't speculation. It's backed by analysis from experts like Lynn Alden and Sam Callahan. In simple terms, when global M2 money supply expands, Bitcoin responds more aggressively than any other asset class. That includes stocks, real estate, and even gold. If central banks are printing, Bitcoin outperforms.
Bitcoin's correlation to other financial assets, and then Bitcoin's correlation to the M2 money supply. So Bitcoin's correlation to other assets, depending on what the asset is, sometimes it has high correlation. There are times where Bitcoin has a much higher correlation than normal to, let's say, tech stocks, right? If Nvidia is going up and Facebook's going up, then Bitcoin's going up, right? And vice versa. But there's also times where Bitcoin's actually very non-correlated. I mean, there was a very long period of time where Bitcoin's correlation to stocks was like 0.15. Right? So if you think of 1 being high correlation, -1 being negatively correlated, so if that goes up, this goes down, and 0 is basically non-correlated, right? So 0.15 is actually pretty close to non-correlated, very attractive for people to put a non-correlated asset in their portfolio, especially when it comes with a high Sharpe ratio and all this stuff. So I think that depending on the market conditions, depending on the time, the correlations change depending on the asset. So at times Bitcoin has been very correlated, at other times not. It is higher correlation today than it was 5 years ago. It makes sense, right? Think about it from kind of a just common sense approach. Okay, if I am an individual and it is 2015 and I'm a crazy person on the internet, frankly, that's what everyone was, I'm going to take as much money as I possibly can. I'm going to put it in Bitcoin. Bitcoin's the only thing. There's no correlation. I'm not like buying stocks and buying Bitcoin. I'm not selling stocks and buying Bitcoin, right? I just own Bitcoin. Like that's it. It was just crazy people. And I say that affectionately because like that was me, right? Was I didn't have any other assets to the most part. And so it was just like, there is no correlation because we all are just in Bitcoin. Now, fast forward, what do you see? Big financial organizations, hedge funds, etc. Now Bitcoin is becoming a part of their portfolio. So as Bitcoin becomes a part of the portfolio, now they do have other assets. So they begin to act, well, are we risk on or are we risk off? Are we allocating or are we divesting? Right now, there starts to be more correlation between the assets because the people holding Bitcoin has changed and they think in a more holistic portfolio construction manner. And so Bitcoin will naturally get put into that and start to be part of these similar types of trades or these similar types of positions. So I think that's important. Now you asked about global M2 supply, and I think this is very fascinating. Lynn Alden and Sam Callahan did a fantastic study, it's probably 2-3 years ago. Bitcoin is the most sensitive asset to global M2 expansion or contraction. So a lot of assets move. If global supply, money supply is increasing, then these assets go up. If it's contracting, then these assets go down. Bitcoin just happens to be the most sensitive, which means that for every net unit of growth of global M2 money supply, Bitcoin will move the most for that growth, right? And so if you want to make a bet on global M2 money supply growing, then you would buy Bitcoin because it is the thing that will express that impact the most, right? So that makes sense. You've also probably seen these charts of like M2 supply goes up and then Bitcoin kind of follows it, right? Well, what's happened in the last 2 to 3 weeks is that M2 supply had gone up, Bitcoin went up a little bit, and now it's been going kind of sideways. So there's 2 schools of thought. Either one is that gap's going to close where Bitcoin will accelerate and will eventually get to that M2 money supply, or maybe it's broke now. Maybe, quote unquote, this time is different. I do not think that this time is different. But I also think that as soon as everyone starts to think something is true, that is when you should start questioning it. And so the second that everyone, including myself, sharing these charts saying, hey, look, this is what happens, right? Like this has historically happened. You always have to think probabilistically and say, well, maybe the probability of this happening for the 19th time maybe a little bit lower than it was on the 3rd or 4th or 5th time, right? And so I do think that Bitcoin is still very susceptible to money supply growth, but I now see, well, there's a fracturing of capital going into Bitcoin, right? So think about it. It used to be you could buy Bitcoin. That was pretty much it. Okay. Well, now if I want Bitcoin exposure, I can buy the ETF, which goes and buys Bitcoin. So you're still getting the exposure to Bitcoin. Dollars are flowing into Bitcoin. Bitcoin's price still there. But what if I want to now buy, let's say, a Bitcoin treasury company? I'm getting underlying Bitcoin exposure, but I'm doing it in kind of this levered vehicle. And so there's some fracturing. Not every single dollar that goes into the Bitcoin treasury company is going into Bitcoin. It's trading at a premium. So there's got to be somebody's paying the premium, right? So if you pay, let's say, a 50% premium, that means that for every $1.50 that you're investing, $1 of Bitcoin is actually held in the treasury. That's 50 cents worth of demand that technically is demand for Bitcoin, right? In this unique type of structure, but it's not going into Bitcoin. So that is being siphoned somewhere else, right? It's having less of an impact. Then if you go and you take a look at, well, let's say the miners, similar type of thing, right? If you start to look at now, there are these funds, there's like real estate, Bitcoin funds, et cetera. Like there are a lot more opportunities to play Bitcoin today, and they're not all dollar for dollar. And so I think that is where you're starting to see some of the, yes, increased interest, but also there's fracturing of the monetary energy going into Bitcoin. A lot of it's still getting into Bitcoin, 70K. Now it's, 110, 120, whatever on a given day. But it used to be that 100% of that demand went into Bitcoin, which caused these massive explosions in price.
While all of these represent Bitcoin interest, they don't translate to dollar for dollar buying pressure on Bitcoin itself. For example, if you buy a Bitcoin treasury company trading at a 50% premium, only part of your dollar actually ends up as Bitcoin demand. This dilutes the impact of inflows. Money is still entering the ecosystem, but it's spread across more vehicles, making price appreciation less explosive than in earlier, more concentrated cycles.